everyone. Today we will carry on with the rest of audit report chapter. Basically, we have defined auditing as a process of accumulating and evaluating evidence about financial statements information to determine and report on the degree of correspondence between such information and the set of accounting standards adopted, whether local GAAP or IFRS. So the final stage in the audit process is preparation of the audit report, which communicates the auditor's findings to interested users who rely on the financial statements in reducing the information risk associated with the financial statements and hence to reduce cost of capital. There are 4 types of audit reports: unqualified opinion, qualified opinion, adverse opinion, and disclaimer of opinion. The last time we have already explained the standard unqualified audit report, and as mentioned, the professional standards provided by the American Institute of Certified Public Accountants provides a uniform wording for the standard unqualified audit report. This is to help users to understand the language of the standard unqualified audit report, and we have explained the parts comprising the standard unqualified audit report, including the report title, address, introductory paragraph, scope paragraph, opinion paragraph, and so on. We have also explained the conditions requiring the issuance of the unqualified audit report, whether the standard one or the one with explanatory paragraph or modified wording. Today we will explain the qualified opinion audit report, the adverse opinion audit report, and the disclaimer of opinion audit report. Qualified opinion is the least severe type of departure from unqualified opinion. Under this, the external auditor believes he performed complete audit with satisfactory results, and he concludes that the overall financial statements represent fairly in all material respects the financial position of the firm, its results of operations, and cash flows in accordance with GAAP. However, there are circumstances that affected the financial statements and required departure from unqualified audit report. In specific, there are circumstances that affected the financial statements and require the auditor to qualify his opinion. So again, under the unqualified opinion, the auditor performed complete audit with satisfactory results and concludes that the overall financial statements present fairly in accordance with GAAP. However, there are certain circumstances that require the auditor to qualify his opinion. Let's give some examples. For instance, when information misstatement exists, the auditor should qualify his opinion if the rest of the financial statements were not materially misstated. For example, underestimating bad debt reserves, or the presence of mismatch between inventory counts and the financial record balances, or even including certain lease obligation in property debt, require the auditor to qualify his opinion with the condition of having the overall financial statement still fairly represent the financial position of the firm, the results of operations and cash flows in conformity with GAAP. Failure to follow GAAP or GAAP violation that don't affect the auditor's conclusion that the overall financial statements are fairly stated should also result in qualification of the auditor's opinion. Qualified report may also be issued when the scope of the audit has been restricted in some aspects, but the rest of the financial statement assertions were audited to the auditor's satisfaction. Hence, when the auditor has knowledge that the financial statements are fairly stated in accordance with GAAP, despite the presence of a scope limitation, qualified audit report should be issued. The term "except for" is included in the opinion paragraph of the qualified report, and the circumstances requiring to qualify the auditor's opinion is explained after the term "except for." The term "except for" is intended to convey to users that the external auditor is satisfied that the overall financial statements are correctly stated in accordance with GAAP, with the exception of a specific aspect of the financial statement. And keep in mind that the term "except for" is only included in the opinion paragraph of the qualified report. This is qualified report of a given firm issued because of GAAP violations that don't affect the fair presentation of the overall financial statements. As you see, the introductory and the scope paragraph are the same as those in the standard report. And the third paragraph is added to explain the circumstances that require the auditor to qualify his opinion. And as mentioned, the term except for is included in the opinion paragraph, and the circumstances requiring the auditor to qualify his opinion is mentioned after the term except for. The opinion paragraph also states that the financial statements present fairly in all material respects the financial position of the firm and the results of operations and cash flows in conformity with GAAP. This is a qualified opinion issued because of scope limitation in some aspects of the financial statements that don't affect the auditor's conclusion that the financial statements are fairly stated. It has the same introductory paragraph as the standard report, and the scope paragraph is slightly altered, starting with the term except as. The third paragraph is added to explain the aspects of the scope limitation, and the term except for is included in the opinion paragraph. It is also mentioned in the opinion paragraph that the financial statements present fairly in all material respects the financial position of the firm, the results of its operations, and its cash flows in conformity with GAAP. The second type of audit report that represents a departure from unqualified audit report is disclaimer of opinion. Disclaimer of opinion is issued when management imposes severe restrictions that prevent the auditor from accumulating sufficient evidence. In this case, the auditor doesn't receive all the information and the explanation that he deems necessary for the completion of the audit. Hence, he is unable to perform complete audit with satisfactory results. The management refuses to provide the auditor all information and explanation that he deems necessary for the completion of the audit. There is no transparency in this case. One concern is the possibility that management is trying to prevent the auditor from detecting the presence of misstated information. For example, the management may be engaged in earnings management activity and is trying to prevent the auditor from detecting its engagement in earnings manipulation behavior. In this situation, the auditor doesn't have knowledge and can't express an opinion on the financial statements. So, management may contribute to the scope limitation by refusing to provide all the information required by the certified public accounting firm. For instance, management may not allow the external auditor to contact the client to verify material accounts receivable balances. In the same manner, management may not allow the external auditor to undertake physical inventory counts in order to match it with inventory balances in the financial records. Please also keep in mind that destruction of accounting records may limit the auditor's capability to deliver judgment about whether the financial statements are free of material misstatements. The external auditor may also disclaim his opinion when there are circumstances that compromise his independence. For instance, when the auditor is auditing his own work, in other words, when the auditor is preparing financial statements for a company while also serving as the auditor for the same company, the auditor can't be expected to form unbiased opinion on the financial statements. In the same manner, if the company has been audited by the same auditor for a long time period, say for instance 10 years, the auditor may have become too familiar with the client and thus lack objectivity in their work. The opinion paragraph of the disclaimer report should include the following statements. We didn't satisfy ourselves as to whether the financial statements are fairly stated. The scope of our work was not sufficient to express an opinion, so we are not expressing an opinion on the financial statements under audit. This is disclaimer of opinion report of a given company. issued because of severe scope limitation. The introductory paragraph of the disclaimer report is slightly altered. As mentioned previously, the first paragraph in the standard unqualified audit report makes the simple statement that the certified public accounting firm has done an audit. This is slightly altered in the disclaimer of opinion report, where the introductory paragraph starts with the term "we were engaged to audit," not "performed an audit." The scope paragraph is eliminated in the disclaimer report, and the second paragraph is added to explain the circumstances and the aspects of the scope limitation. The opinion paragraph of the disclaimer report includes the statement "we were unable to satisfy ourselves. The scope of our work was not sufficient to enable us to express, and we don't express an opinion on these financial statements." This is disclaimer report issued by an external auditor because of the existence of non-independent relationship between the auditor and the client. It is stated that we are not independent with respect to the company and the accompanying balance sheet as of December 31st, 2009, and the related financial statements of income, retained earnings, and cash flows for the year then ended were not audited by us. Accordingly, we don't express an opinion on them. The third type of departure from unqualified audit report is adverse opinion. Adverse opinion is issued when there is material misstatement in the financial statements that is likely to mislead the user's decision-making process, or when financial statements haven't been prepared in accordance with GAAP and the accounting standards violations are so widespread that the auditor can't say that the financial statements present fairly in accordance with the accounting standards generally accepted. Let's now give some examples of the circumstances that require the issuance of adverse report. If the client is using replacement cost to measure fixed assets rather than historical cost, or if the client is using fair value to value inventory rather than historical cost, and the case is severe, adverse opinion should be issued. If the client failed to consolidate all its operations, in other words, if the client failed to issue one set of financial statements reporting for the parent and all subsidiaries, adverse opinion should be considered. If the client didn't record the material accounts, such as revenues, properly, an adverse opinion should be considered as well. Finally, excluding the liability from the balance sheet that, if recorded, would significantly increase accounts payable and hence decrease net income, should result in adverse opinion audit report. The term "do not present fairly" is included in the adverse opinion paragraph. Finally, you need to recognize that adverse opinion is the worst possible outcome for a company. It can have a lasting impact on the company's reputation and legal consequences if not corrected. That's why regulators and investors will reject the company's financial statements following the issuance of adverse opinion report, because the issuance of adverse opinion report implies that financial statement information are misleading. This is an adverse report of a given firm issued because of severe GAAP violation. It has the same introductory and scope paragraphs as those in the standard report. A third paragraph is added to after the scope paragraph to explain the circumstances requiring the issuance of adverse report, to explain aspects of GAAP violation, and the opinion paragraph includes the term "do not present fairly." The final point that will be discussed in this chapter is materiality assessment. With respect to information misstatement and GAAP violation, qualified report is issued when the effect is material. However, the condition is not severe and doesn't affect the fair presentation of the overall financial statements. On the other hand, adverse report is issued when the effect is highly material, significant, and the condition is severe, so that the overall financial statements are misleading. With respect to scope limitation, when restrictions are imposed on the audit process, qualified report is issued when the scope restriction is not severe, so that the auditor has knowledge that the financial statements are fairly stated. On the other hand, disclaimer report is issued when the scope restriction is severe, so that the auditor doesn't have knowledge about whether the financial statements are fairly stated and can't express an opinion on the financial statements. Qualitative and quantitative factors should be considered when making judgment about materiality. Quantitative factors such as the dollar magnitude of the effects, and the qualitative factors such as the significance of the item to the entity. For instance, significance of inventory to a manufacturing company will be different from its significance to a service sector company. To sum up, in this session we have explained the conditions requiring departure from unqualified opinion, and this can be classified into gap violation, scope restriction, and lack of independence. In case of gap violation and the condition is not severe, so that the overall financial statements are fairly stated, qualified opinion should be issued. In case of severe gap violation, so that the overall financial statements are so materially misstated or misleading, an adverse opinion should be considered. In case of scope restriction that is not severe, so that the overall financial statements are fairly stated, qualified opinion should be issued. However, in case of severe scope restriction, so that the auditor can satisfy himself that the overall financial statements are fairly stated, disclaimer of opinion should be considered. If there is non-independent relationship between the auditor and the client, disclaimer of opinion should be issued. Thank you.